Today in this presentation, I'll kind of be talking through how I choose what to trade, as well as how to actually go ahead and make a trade. Because if you haven't done it before, it's going to be a little bit of a learning curve here, and hopefully this presentation kind of speeds that up for you. So here's a little bit of kind of what I'll go through today. First, kind of putting the pieces together that you've kind of learned in this class so far. Kind of a high-level overview. We'll talk about weekend and daily routines. What exactly is a setup, trade execution, position management. I'll go through an example trade that I did previously this year, and then we'll also talk a little bit about post-analysis at the very end of it. So first, let me move the zoom tool here. First, just kind of a high-level overview of a trade. These are kind of the four main components the way I see it. First, in order to trade a stock or a symbol, it's kind of obvious. You have to have it on your radar. You have to be aware that the company exists, and you have to identify some type of promise in it that it basically has potential. Then after it's kind of on your watch list, on your universe list, you actually have to go ahead and identify a promising setup that meets your criteria, that meets your rules. And at that point, it can be put on your watch list, and you're actually you're ready to go ahead and make a trade. Then the next step is to actually go ahead and execute and manage risk. There's some emotions that happen right at this step, which I'll talk about later on as well. And after that, after you've managed your risk initially, then it's about managing the trade once you do have a position. So those four steps are kind of the high-level overview, and I'll kind of go through much more details of each of these steps in this presentation. So first, the first step is getting the stock on your radar. So how do we go ahead and do that? Well, it basically starts with the weekend routine. This is basically the list of steps, your process on a weekend to build your universe list, to do screens. I know you guys have been given the Grow 250 list, which is a great universe of stocks to start with. But this process is how you take that larger list of stocks, the Grow 250 list, and narrow it down to stocks that are potentially actionable for that next coming week. So the inputs to this kind of weekend routine, as I mentioned, are screens in different lists like the Grow 250. Then within that list, look for the best stocks and the best setups as well, which we'll go through in just a little bit. Then the output of your weekend routine should be your watch list for that next coming week, as well as kind of a feeling about the overall health of the market. You can use something like the GMI, you can look at the indexes, you can look at what IBD is saying, but basically you have to have some sort of sense of whether the market is right for your style of trading, whether it's time to be aggressive, or we're in a bear market for the majority of this year. Is it time to be defensive and really wait for the right environment that could come very soon? But the time right now is to be defensive and to be very patient. So kind of the inputs of the system, I've got an engineering background, so this is kind of how I think. Inputs are your watch list, your screens, your universe list, the market indexes. You do all these steps in your weekend routine, and then the output is your final focus list and that situational awareness about the market. And I think this is really key. If you don't do this weekend routine as well as the daily routine, which I'll talk about later on, you're not ready to trade. You have to approach this like a business. You're not seeing athletes go out there and competing if they haven't put in the work and haven't practiced enough. They're just not going to be able to basically participate at the level that they're capable of. And we have to make sure that we're ready to execute. For me, I've got a rule: if I sleep in, miss my alarm, aren't able to do my pre-market routine, I don't trade that day because I'm simply not ready, and I'm more likely to make a mistake and lose money doing something stupid than if I had done my pre-market routine, I've set all my alerts, I've done this whole process, so I'm actually I'm ready to trade that day. So once you've got that final focus list, here's a little bit about what it should include. Basically, you go through the Grow 250, and you're looking for stocks that are potentially actionable and are the best potentially actionable stocks that could basically move that next week. And basically, I think this is really key to remember. It's not all about the daily chart. You also want to make sure that it's set up on a weekly chart. It's near all-time highs. It's had an initial thrust of power. It's basing but close to base highs, that type of thing. You want to make sure that there's something special going on a weekly chart. If it's just set up on a daily chart, it's not really quite ready just yet, and you have to wait for those timeframes to kind of align. Depending on the market, my final focus list will have around 10 names, usually a little bit more than that. But when the market isn't so great, there could be 5 names, there could be three names, there could be none. But when the market's really going, setups are really working, breakouts are moving quite quickly, it could be a little bit bigger than those 10 names. So this is kind of the final output from that weekend routine, and it's really important that you have this so you're ready to trade. And I think this is a really important reminder. When we're trading the stock market, we have the luxury of choosing and focusing on the top 1% of stocks for our system. We don't want to settle for a mediocre or a decent enough setup. We can wait until the hand is stacked in our favor. We can take pitches all day until there's that one fat pitch right down the middle that we want to take. So what does that look like when it comes to the stock market? Basically, we want to focus on a few of these different criteria. First, visionary stocks. The story is what drives a stock up 1,000%. Group moves, stocks that are moving with their entire industry group, that's key as well. We want to focus on stocks that change how we work, how we live, how we play. Think about what's kind of impacted your lives immensely. I'm sure all you guys have Teslas. Obviously not, but Tesla is a recent example. Google, everybody uses Google every single day. Chipotle, Facebook, Shopify. When these stocks were new and when these companies were new, they grew at an incredible pace because they were impacting so many people. So that total addressable market is something that's really important. And just in general, recent IPOs have a little bit more potential than a company that's existed for 50, 100 years, just because they have more of an ability to reinvent themselves, come up with disruptive products. This doesn't mean that a mature company can't do the same thing, but those recent IPOs that have come public, within the last 1 to 2 years, there's just a little bit more potential there. Another way to look for these visionary stocks is to focus on the fundamental numbers that I'm sure you've learned in this class. Looking for over 40% earnings growth quarter over quarter, sales growth quarter over quarter, greater than 15% ROE, even higher is better, great annual EPS estimates. All these different things that we can screen for are a way to get those stocks in your system and make sure that we're focusing on a strong universe of stocks. Then the other component here is you can also screen for just top tier technicals. So looking for stocks trading at all-time highs that are in strong uptrends above a rising 50, 200 SMA, stocks that are making new highs that have an up-down volume ratio of greater than 1.3, that are creating Mark Minervini VCP, that are forming clean bases, stocks that have doubled off the lows. That's something that David Ryan looks for specifically. Stocks showing relative strength during corrections. That's a great thing to be looking at right now. So basically, we want to make sure that from both a fundamental and technical perspective, there's something special and A+ about the stocks that you're trading and that are basically forming your watch lists. So here's a slide that doesn't quite fit too much into the rest of the presentation, but I think it's important given the overall context of where we are right now. I'm not trading the same way I was trading in 2020 right now because the environment is different. We're in a bear market. Things are very choppy, volatile, and things just aren't trending as much. So you've got to adapt and make sure that you're not stuck within your ways and, just forcing the market and forcing your style in the market. You have to adapt a little bit and make sure that you're not, head bent on one style and just losing your shirt when the overall environment changes. So in strong markets where we're above a rising 250 SMA on the indexes, above a rising 21 EMA or 30 SMA, that's a great way to check it as well. In a strong market, breakouts will be working really well. Trades will be providing positive feedback. They'll actually be working for you. We'll be making new highs. In that type of environment, what you want to do is be aggressive, capitalize on breakouts, focus on the leading stocks, and ride trends. That's a great environment to be trading in. That's an easy dollar environment. You can use normal position sizing here because things are working for you. However, in a market like here, which is a tough market to learn how to trade in, where we're below a declining 50, 200 SMA, below declining 21 EMA, trades are not working. There's negative feedback when you put on a test long position. In this type of environment where it's very choppy, you want to be the opposite of this. You want to be defensive, trade less, trade smaller, and be patient. And if you are going to take some trades long, you have to make sure that they're A+ setups in top groups if you are going to trade long. And on the flip side, you can also trade inverse ETFs, which is a great way to capitalize on these declining trends. So I think this situational awareness is something I've definitely learned. Last year, we were very choppy. There's a little bit of this as well, but then definitely this year, if you're trading breakouts like you're trading them in 2020, you'll experience a huge drawdown. So you have to adapt and make sure that you're aligning your actions with the environment that you're in. So moving on, we've got the daily routine here. So this is something that you'll do every single day. Part of it is before the market opens. Part of it is during market hours. Then there's also the part of it that's after the market. So starting with pre-market, this is what I was talking about when I said, if I don't do this, I'm not ready to trade that day, and I won't. So first, you have to ask yourself, what is the market doing? Are we gapping up? Are we gapping down? Are we opening flat? Is there a big news event going on that's impacting things? What stocks are moving a lot in pre-market? Why is that? What's moving on volume? What's moving with large price moves? That's all important information to keep track of. Then, even more important than that, is what could the market do today? And how will you respond? If this, then that. If you think about this beforehand, then in the moment, you don't have to kind of guess and your emotions will come into play. If you think through your plan beforehand, then you're ready, and it's all about just executing what you already decided. And I find it helpful to write this down. You can type it out in a document. I like writing it by hand, but whatever the case, you have to be ready. If the market tanks, if the market takes off, what are you going to do? How are you going to respond? How are you going to manage your positions? Then in pre-market, you also want to go ahead and adjust your stops. So once you guys have positions open, each day you want to adjust your stops to make sure that they're not too far low, or they're not choking off the trade. This is a really important part of it. And also, I always make sure to set alerts in TC2000 where I'll have to basically make an action. So if it breaks below this low of the day, I'll sell some. I'll sell a third. I'll sell a half. So setting those alerts helps keep track of your positions and makes things a little bit more robotic, as well as letting the computer work for you, because then you don't have to be staring at a chart all day, which is not fun. Basically, then once you get an alert, you get a text, you get an email, you bring up the chart, and then you make a decision. Then, as I already mentioned, you basically want to set a daily actionable list. So this is a subset of your weekly focus list, where these are the stocks that could go that day. So you want to have the best of the best setups right here. You want to set your alerts a little bit before your buy point for these setups. And as much as you can, you want to determine where your stop loss is going to be, what your position size is going to be beforehand. So once again, when you're in the moment, all you have to do is execute what you've already written down in that daily plan. So once you've got all that sorted, which should take honestly about 20 minutes, it shouldn't take that long at all. A lot of the work should be done the night before and on the weekend. Once the market actually opens, what you want to do is just execute. So if a stock hits your stop loss, you're out. If it breaks through a pivot and you've got an alert that's triggered, you go ahead and buy if it meets your criteria. So it's all about executing what you've already decided beforehand. You don't want to be in the situation where you see a stock that's being mentioned on Twitter during the day at 10 a.m. You go ahead and buy it. It's already up 10% on the day. It pulls back 8%. You sell because you're scared and you're losing money, and it rips again 15%. That shouldn't be your process. Your process should be very individual, and basically you should have everything planned beforehand, so you're not basically calling audibles during the day. That's what Mark Minervini calls it. And having random actions. Everything should be thought out and decided beforehand. So after the market closes, your work's not done. You want to have a post-market routine where you basically screen for new ideas, go through your watch list, and go ahead and build that daily actionable list for that next day. And once again, this should be pretty quick, about 20 minutes, and you can go ahead and adjust your stops as well with your broker. So just like that weekend routine, you're taking into account the market action, the daily setups. You do your daily routine, and then you come out of it with your daily actionable list. You go ahead and manage your positions and adjust your stops. All right, so that's kind of the identifying stocks to be on those larger lists. And now let's talk about identifying the setup. So first of all, what is a setup? For me, this is kind of how I think about it in my own head. It's basically a repeatable price pattern that indicates that a stock is under accumulation and is at a key spot where we can expect a large directional move, either upwards or downwards. And what does under accumulation, how do we identify accumulation on the charts? Basically big volume to the upside and strong prior price moves. And what's important is that with this setup, you want to have a clear pivot point or buy point where you're going to enter the trade. And you also want to have a tight and logical place to manage our risk against. So for me personally, I often set my stop loss at either the low of the day, the low of the previous day, or the low of that week. And that just kind of makes sense for me, makes sense for my time frame. But you always want to have a clear spot where you can set your stop loss and you can say with certainty that that setup has failed. That's basically where you should set your stop loss. What would have to happen to the chart that would tell you that the setup has not worked? And if so, you should get out. And what's important as well with these setups is, in an ideal world, we want to be at a profit right away. I found that the best trades I've ever made, the stock has just gone right when I bought it pretty much. Or I'm even chasing it a little bit as I'm putting in my order. We want to be at a profit right away, and we want to have that cushion right on that first day where we can sit through a little bit of a pullback the next day, and we're just basically starting that trend. So I'm sure you guys will find this. Your best performing stocks, you'll buy it and it'll work right immediately. And yeah, there'll be little stress on those trades. And here over to the right here, let me actually bring up the laser pointer. This is my incredibly detailed drawing here. This is basically a representation of a setup. Very simply, we've got an initial thrust upwards in terms of price. We want to see volume included here. Then we've got a pause consolidation and then a resumption of that longer term trend where we break through that pivot. So this at its simplest form to me is kind of a visualization of a setup. And this is basically a breakout. This is even a pullback buy where you're waiting after the pullback has finished, where it starts moving up again. You can buy right here. So this is kind of a classic setup in terms of how I view things. So in terms of my preferred setup, the two that I pretty much use, I look for short-term volatility contraction where price is getting really tight, either up the right side of a base or after a stock has already broken out and is pulling back into a moving average, tightening up. And often, as I mentioned before, I set that stop loss at the low of the day or the low of the contraction. And I'll get into a few examples later if you can't quite understand what I'm saying here. In fact, here's an example. So this is Oxy from earlier this year. We've got a base that's forming. You can see it pulled back into the 200-day moving average. That's this black line here. The blue line is the 50-day moving. Yes, the blue line is the 50-day. The green line is the 21 EMA, and the orange line, you can ignore it. It's just a very quick 5-day simple moving average. But we're pulling back into the 200 SMA. We're forming a base. You can see that the base pivot would line up with this prior high, which would be, it technically broke out right here and failed. But I'm looking for those price contractions, those short-term flags, as it's starting to move up off the base lows. So there's one example here. We get a nice move up on higher volume. Then we get that move up. It starts moving sideways again, gets tight under this prior pivot, and then has another short-term breakout. So ideally, I'm buying right here as well as right here. Then you can see it tries to break out, fails initially. Maybe you're stopped out of this position, but it finds support at that rising 21 EMA, and then once again, it moves up. You've got another opportunity here after the base breakout where we go quiet and tight for 2 straight days. We break out again on an increase in volume, and then we get a longer term consolidation, pull back into that 21 EMA, as well as kind of a confluence of that prior high if you draw that line across. And then we get a nice big breakout on an increase in volume. And this is where I want to be buying right here as it's breaking this short-term trend line as well as through this prior high. It pulled back nicely into the 21 EMA, was supported, and now it's moving up again on volume. And this is kind of what I was talking about. Right after you buy, you want to be at a profit right away. That next, that day you should be at a 3% cushion, ideally, 3-5%. Obviously, the higher the better. Then the next day it still goes. Then it goes quiet and tight for 2 days. Then we resume that again. So this is kind of the ideal scenario where right after that pivot point, right through this point, we've got a nice cushion where we can either take some off or we just have a nice cushion to work with so we can kind of settle down and just manage the position using our sell rules. So that's kind of it in terms of identifying the setup. Now let's talk about the actual mechanics of entering the trade. And I think this was what I lacked the most clarity on after going through this exercise. The fake brokerage didn't really feel real. And the first time you put real money on the line, it's a little bit of a shock and takes some getting used to. So hopefully this helps here. First, it's really important that, as I mentioned before, you basically prepare adequately. So the stock that you're trading should be on your daily actionable list. I like to have about 5 stocks on this list, so I keep it very simple. And even 3 is better. I used to have about 10 stocks on this list, and I found that it was too much to keep track of, too many alerts going off, and I was distracted, and I ended up not executing well on any of them. So under 5 stocks is preferred in my opinion. As I mentioned before, you want to predetermine your stop loss and basically ask yourself, where does the setup fail? And that's where your line in the sand should be. And ideally, as I mentioned later, that should be, 3%, 6% max. You don't want to give it too much room. And you can basically decide your stop loss on either a dollar amount or a percentage basis. So percentage basis would be if you bought it at 100, you set your stop at 95, that's a 5% loss. Or you can think of it in terms of dollars by basically saying, I want to lose max $200 on that trade. And you basically have to do the math in terms of how many shares you bought and your buy price, and then where you would have to sell to make sure that you're ensuring a $200 loss. But basically, both of these can be predetermined, and you can make sure you never lose more than you expect on any given trade. Then, as I mentioned before, you can predetermine your position sizing, and this depends a little bit on the overall environment. Right here, when we're in a bear market, I'm not trading as large as I was in 2020. My normal position size right off the bat in 2020 was about 12.5%. Now it's about 5%. So until the market really says that I can increase my size, I'm keeping it very small. And you also want to consider the quality of the setup. Going back to that slide where I talked about all the amazing characteristics, where it's in a group that's acting well, where it's a visionary stock, it's got great technicals, great fundamentals. If it ticks all those boxes, I want to size a little bit more because it's a more promising stock with more potential. But if it's a C quality setup, maybe don't even take it, but also you want to size that a little bit lower, especially if the technical setup is not quite as good. Then, as I mentioned a few times, alerts are your friend. Set them, and you can even set early alerts, meaning that if your pivot point is at 100, you can set an alert at 98. So if that's triggered, you know that the stock is moving upwards, and then that gives you the time to bring up a chart and actually take a look at it before it's actually pushing through that 100 level. So looking at the chart, I think this is a really important question to ask yourself. Would I take this setup 100 times out of 100? Remember, it's not always about will the setup work that time. It's about having an edge, and over time, this setup would be successful. And you also want to ask yourself, can I manage risk easily? If you can't manage risk within 5%, it might not be the best setup. You might be buying a stock that's already extended, and there'll basically be a better time to buy later on in the future. It's also important to ask yourself, is it part of a group move? Is that overall theme working? So this year, the oil and gas names have been, the best performing stocks. Solar had its time, a few months earlier, and biotech has been strong as well. So stocks in those groups collectively act better when the rest of the group is also acting well. So you want to consider that as well when a stock is moving on that day. How are other stocks in that group performing? If it's the only stock acting well, maybe it's not the best time to enter, but if everything's moving together, that kind of increases the odds and puts the probabilities in your favor. You also want to ask yourself, is it moving on volume? For me, price movement comes first, but it's always better to see that, volume buzz is plus 300%, plus 1,000%. The higher, the better. That just basically shows you that institutions are driving the move instead of just, a few people buying, 10 shares, 100 shares, 1,000 shares. We don't really move the market. It's the big institutions buying tens of thousands of shares that are really going to push a stock and allow it to trend for an extended period. Then the last thing I want to talk about on this slide is kind of considering multiple time frames. So this might not be something you guys have experienced or looked at before, but this is basically a daily chart of AMR on the left-hand side, and then also a chart of AMR, but on a 65-minute time frame. So the difference is each of these bars represents 1 day's worth of price action, and each of these bars represents 65 minutes. So this is a shorter term time frame. Now, what's really important when you're looking at multiple time frames is you never want to look at a smaller time frame if the stock isn't set up on a larger time frame. The higher time frame always takes precedence. That's really important. You don't want to be stuck at looking at 5-minute charts and trying to find a setup when it's not ready to go on the daily, it's not ready to go on the weekly. So here it's within a handle. This is AMR. I took the screenshot right today. It's forming a little bit of a handle here within a base. If it pushes through this pivot, it could be actionable. And then this is basically a close-up view of that handle on a 65-minute time frame. And you can see that I was moving up on volume here. I haven't looked at it today, how it's done. But this kind of smaller time frame gives you that granularity, and you can even find kind of buy points earlier, a little bit earlier, before it lines up with that daily pivot. So for me, I love to find a setup on a daily chart, then look at the 65-minute time frame to actually go ahead and execute. Just because you can manage risk a little bit tighter, and you can basically look at the internals. How's the stock actually performing? What does volume look like? You can see how huge volume was here. Yeah, just gives you a little bit of added granularity. So once you've basically identified the setup, you've got a stock that's triggered an alert. Let's talk about actually making the trade. Basically, I've got two monitors here. On one monitor, I have my broker up with the order ready to go. So I just have to go ahead and press submit. Then on the other monitor, I basically have the chart. So I'm watching the price action in the morning. And then if it actually goes ahead and triggers my pivot, I'll go ahead and enter the order on my other monitor. Now, you don't need two monitors to trade. And some people have crazy setups like 60 monitors. That's way too much. But have a tab open with your broker as well as your charting platform TC2000 up at the same time. You can easily swap in between them. And having this order ready to go, I think is something that I've learned to do, because sometimes in the morning things are moving really fast, and if you have to spend the time to go ahead and log into TD Ameritrade, create an order, decide how many shares to buy. By the time that you're done with that, it's already so far past your buy point that it's really hard to manage risk properly. So as much as you can have this ready to go beforehand, as I said, with the number of shares that you're going to buy decided, the better it really is. Then, while you're making the trade, you want to basically manage the alerts that pop up. The first stock to go is the first that I trade. So if you've got two stocks that are set up properly, one's pushing through the pivot, one hasn't gone yet, I'm always just going to take the first one that triggers my buy point. I may buy the other one if it does eventually push through, but basically it's always first come, first serve. Then as the stock is moving through that buy point, I'm always looking for above average volume. And you can use that using the volume buzz. I've got a screenshot of my daily focus list from today here, and you can see volume overall was pretty low. But if you see a stock moving up on plus 100, plus 50%, plus 300% volume buzz, that tells you that there's a lot of volume coming in, and likely institutions are involved on that particular day. And here's where I want to get a little bit into the emotions here, because I know from experience that when you're just starting to trade, it can be a little bit nerve-wracking. You'll feel nervous. Obviously, there isn't real money on the line yet, but you guys obviously want to get to the point where you can trade your own accounts, trade your Roth IRAs, and there's going to be a lot of nerves and emotions that come into play when you're trading in real dollars. So I think one of the most important things is to remember that confidence comes from preparation. And if you go through all the steps I've kind of talked about, where you outline your weekly routine, your daily routine, you've got all your alerts set, you're ready to go, you predetermined your stop loss, you know exactly how much you're going to lose if you're wrong, then it's all about just, having confidence in your setup, having confidence in your process, and understanding that even if you lose on one trade, overall, because you have an edge over the course of 100, 200 trades, you're going to make money. So you have to have confidence in that, and that's going to allow you to execute properly in the moment and ideally eliminate hesitation. So once you've done that and actually entered the order, then right immediately I set a stop loss in with my broker, and I also set alerts that would basically warn me if the stock starts dropping from that point. And I think it's really important to set those right away. In the past, I've forgotten to put in a stop loss, and I've lost money because of it. So you don't want to be put in that position. You want to set that stop right away. And that's definitely a very bad mistake to make. And one more thing I want to talk about in terms of my daily focus list is is basically my column setup here. So I've got price, percent change, volume buzz, and then I also like these two columns here where you've got the percent from the open and the percent from the low. So these are both percentages. Basically, I use this to determine, how fast is a stock moving on that day? Is it acting better than other stocks? From the open, it's basically going to tell you, is the stock moving a lot? And if we're up 5% from the open, maybe we're a little bit too stretched. But if you're only up 1% and a lot of stocks are acting worse than that, then that stock is showing relative strength and could be one to watch later that day. And very similarly, percentage from the low, say we get a gap down in the market and stocks are doing quite terribly, but then we start to see a bid come in and stocks start really rallying. This column allows you to identify the stocks that rallied the strongest. So that's, again, a sign of relative strength. And those are stocks that you should focus on later on. And then this is basically the stock 10-4 as well, which I don't use too much. But I think these two columns are definitely really useful. And they're pretty easy to set up. You basically just, I can't think of the PCF right now, but I can email it to you guys later. Okay. So after you've actually gone ahead and executed on a trade, it's all about, from that point on, managing the position, managing the trade. So first, you want to remember that the goal is to catch onto a trend and let that trend work for you. You don't want to be micromanaging things. You want to let the market do what it's going to do and generally go from left to right and trend above the moving averages. And the overall goal is to get those rising moving averages above your cost basis so you're not taking any heat, and then just letting that trend work for you until we see that trend change and the stock starts breaking down through those moving averages. It's also important to basically keep it simple. I found that the more experienced traders who I've interviewed, their process is so simple, and they've kind of refined it over the years. They're not using 1,000 indicators. They're not looking at 1,000 signals. They're looking at one or two moving averages. They're looking at the price action itself and letting that guide their decision making. So keep whatever rules you're making simple enough that somebody else could easily follow them. I think that's really important. As you get more advanced, you can also start looking for, price action caution signs / red flags, such as breaking below moving averages, failed breakouts, accelerated moves either to the upside or downside, breaking the last week's low on volume, and also the overall group acting very negative. These can be all signs that the trend may be coming to an end and maybe you lighten up a bit, or you're just more on guard and waiting for your sell rules to take hold. Let me get a drink of water real quick. So here's kind of example going into the past, going back to 2017 of Shopify. This has been a fantastic stock. And this is, again, another example of kind of what I look for. We've got a prior strong uptrend where it was up nicely. Then we've got a nice consolidation basing pattern. It starts forming higher lows here off the lows. Then it forms a really nice flag here back into the 21 EMA, really nice controlled pullback on a decline in volume. And then from this point on, we get a short-term breakout through that flag. This would be the ideal entry spot. Even this next day in the morning as it breaks through this high would be pretty good. And then we get that full breakout and you can see the volume come in, really telling you that institutions are behind this move. So once you're in that trade, you basically want to let that trend do its thing above the moving averages. You can see how quickly that 21 EMA gets above our cost basis right here, if we bought it right here. And even if we bought it early this morning, once we're at this spot right here, the 21 EMA is above our cost basis. So we can let it work as long as it's trending above that moving average. We let it do what it's going to do. And you can see how it respects it multiple times. And until it really closes below it, this is the first close here, you're basically sitting pretty, and it's an easy double from here above that 21 EMA. If you're a little bit more of a kind of longer term trader, you can also use the 50 SMA to kind of do the exact same thing. At this point, we're above the cost basis if we bought it right here on the 50 SMA. And even if you bought it on the breakout, at this point, your cost basis is above or below that 50 SMA, and you can just basically let it work, let it trend for you. And until it really starts breaking down and closing below those moving averages, you let it be, you sit back and relax and let the trend do the work for you. So instead of trying to micromanage everything and get super scared on this day, you just let it do its thing, let it base, let it resume the uptrend, and trust that the accumulation is with the stock and wait for that significant trend change. So that's basically the goal. Obviously, this is this is a good example because I picked it, but this is the goal whenever we get a nice trending market to let the stocks do what they're going to do once we buy right and we just sit tight and let it go. So here are some kind of suggested sell rules that you can kind of adapt to your own style. In strong markets, you can raise your stop losses to break even. Once the stock rises 1.5 times your initial stop loss, you can also wait until that 21 EMA catches up to your cost basis. That's another way to do it. Then you want to eventually sell when there's one to two closes below that 21 EMA. You can sell 2/3 of your position, and then you can wait to sell that remainder 1/3 when it closes below the rising 50 SMA. So if we go back to this example of Shopify, we buy it right in this area. It's trending, trending, trending. We get one close below that 21 EMA and then a second close right here. So here at this point, we'd be out at about $9 after entering at about 4.5, around $5. So a really nice trade, pretty stress-free. And then eventually this spaces out and even continues higher. You can rebuy it. Or if it breaks that 50 SMA, you can sell that last 1/3.
So Richard, that's a beautiful green line breakout line also.
Yeah, it's absolutely not quite 3 months, but it's it's in the spirit of a green line breakout. 100% agree. Yeah.
Right.
Yeah, and I'm always looking to buy close to that green line breakout, maybe not on that green line breakout, but I love buying consolidations right below or right above the green line breakout, if that makes sense. Like that's a great setup for me.
That's called a cheat. That's what Mark would call a cheat, right?
Exactly. Okay, so let's talk about right now. How have I kind of switched up my sell rules a little bit because things are a lot faster, things are choppier, things are more volatile, and you can't use these rules and expect the same results as in 2020. That was a crazy easy market. And if you wait until break even to move up your stop to break even, you're going to take a lot of 3%, 4% losses, and those will add up. So you basically want to be a little bit more proactive, raise your stop to break even a little bit quicker when the stock rises 2 to 3% profit. That's the rule that I follow. And then I even go to the 65-minute time frame, which I'll show in the example later, to manage my position. And I also like to nail down profits a little bit faster, at least on part of the position when I do have them. Looking at kind of my average gain over, the past 100 trades, what has it been? Oh, I see that I've got a 10% profit. Maybe I'll take half off, just let the rest work. And I've guaranteed basically a 5% profit on that part of the position. Okay, so I've kind of talked a lot of theoreticals. Let's kind of talk through the 4-step process and use an example of a trade I did earlier this year of VTNR. So first talking about how did it get on my radar? Well, it's basically one of the strongest stocks in one of the strongest groups at the time, which is the oil and gas theme. It's in the oil and gas refining. I'm not quite sure where this group is, but it was basically ranked. This is a recent screenshot, but it was definitely top 10 at the time, industry groups. And it was one of the stocks that had been performing extremely well. It had come off its lows at around $3 all the way up to when I was looking at it, just under 15. And it was an extremely strong stock. Sales growth was plus 61%. Institutional fund ownership was increasing. So it kind of ticked all those fundamental boxes. And the most important thing for me was that it was in the strongest theme in the market at that time. And even just looking at the chart here, look at what the SPX was doing, this gray line here, and what the stock was doing. The market was falling apart, and this one was basically making all-time highs. I think it's just below all-time highs. Is actually a green line breakout right around this level. But the key thing is here is this was breaking out and moving higher as the market was falling apart, and that really shows in that relative strength line, which was zooming higher right at 1 o'clock. So that's basically how it got on my radar, and that's really important. It was in a leading group at the time. So what was the setup? You can see I've drawn in the green line. You can see if you extend it, it's about around 15 here. So the setup for me is we had an initial move up higher on an increase in volume. We had an attempted green line breakout. And then, as I said before, I love consolidations right below or right above, or in this case, basically right at a prior green line or prior all-time high. We are also pulling back into the 21 EMA. You can see volume is declining as it's pulling back. And even though it's declining, you can see that price action is relatively tight, and it's not just falling apart. It's kind of drifting sideways instead of pulling back sharply, and that's really key here. Now, I did actually try the stock here on this day where we had a slight gap up. It pushed higher in the first 65 minutes and then basically gave it all back and pulled back into the range. I took a small loss on that, I think about 1%. I sold it as it kind of broke this prior close. But I do want to be honest, I took a small loss on this beforehand. But that's really key here. And this is actually one of the things I like about this trade is that even though I had a failed trade on this, I didn't take it off my watch list. It was still actionable. It was still setting up nicely. And I basically took it the next day and more than paid for that small loss. So the overall setup, as I said before, we've got a longer term uptrend. We're above the rising 21, 50, 200 SMA. We had a nice initial thrust into all-time highs on an increase in volume, a gentle pullback on declining volume, and then a potential actionable spot through this downward trend line. So here's the trade execution here. This is the daily time frame on the left that we're just looking at, and then this is the 65-minute time frame on the right. So remember, each of these bars represents one 65-minute block of time and price action. So here's basically the failed move up that corresponds to this bar where initially we gapped up through this pivot. That's why I bought as well. I bought right through this level initially. Then I basically sold as it undercut this prior low and the prior close. And then you can see it failed, but we didn't really lose the overall setup. We were still just kind of pulling back sideways. And I bought it once again in this morning through these pivots, and it basically worked immediately on volume, which is nice. I was at a profit right away. And yeah, that's basically my entry. I managed my risk right at the low of the day on that day, which is about a 4% stop loss from 14.5. And 4% is, it's pretty much good. I like 3% if possible, but 4% is not too bad. I like how it immediately got back above the moving averages on this lower time frame and started working and trending beautifully above that 5 SMA on that time frame. So once I was in the position, how did I go ahead and manage it? That's going to be a key question that you have to ask yourself. So because we're in a choppier environment, I'm managing things on the 65-minute time frame. In a strong bull market, I'm not doing that. I'm doing it on a daily chart. So I want to be clear about that differentiation. Because we're in a choppier environment, I'm kind of shortening my focus and just trying to get, quick swing trades out of it instead of longer term trends like we saw with Shopify. So here we are on that 65-minute time frame. This is the bar that I bought right through this high as well as this high at around 14.5. Then you can see it trends nicely above the 21 EMA on this time frame. And I basically sold it once we had 2 definitive closes below that 21 EMA, this green line on that time frame. I didn't sell at the high. I didn't sell at the low. I sold when the trend for my time frame basically changed, and that's why I got out on this day. We had a slight gap down. It rallied initially and then broke down, and that's when it basically triggered my stop losses. I think overall I netted about 12% on the trade. I think at the highs it was up about 20%. So risking 4% to get 12%, that's a 3-to-1 ratio, and that's pretty darn good in this environment, especially during this bear market. So looking back
on that trade, Richard, did you move your stop up as it rose?
Yes,
at all?
Yes. Yeah, that's a great thought here. Yeah, on this day we had an initial gap down, moved lower. As it pushed higher, I moved up my stop to this higher low, which is at the low of this bar. Then similarly, here we had a pullback into the 21 EMA area. We rallied higher. I moved up my stop here. So that's where I had my stop loss. And then I was watching it versus that 21 EMA. So as it was making higher lows, as it moved higher, I was adjusting my stop loss to make sure at the very least I made money on that trade. So here are some kind of trade thoughts looking back on this. As I mentioned before, one thing that I did was really good is I didn't let that small loss, prevent me from trading the stock again. I watched the stock reset. It formed another setup on that lower time frame, and I went ahead and executed it, managed it pretty well. And as I said, in a bear market, it was a pretty darn good trade. The key in bear markets is to not lose money overall. You want to preserve the gains you made in the previous bull market. So basically take whatever trades you can get. One thing I could have done better is maybe sell it sell a little bit more into strength here. We had, it didn't quite manage to break out here. Then we had a big reversal here, which ended up closing all right, but a little bit of a sign of weakness, and an inside bar and then an inside bar and down. In hindsight, you could have sold a little bit here, but once again, that's kind of getting into micromanaging things. And you could always have sold higher. So you don't want to, beat yourself up too much, but that's one thing I could have done a little bit better here with this trade. And I think what's key whenever you're looking back on your trades, which you're going to do for the final report, is you want to think about what you did right, what you did wrong, and how you could improve the next time. And this last sentence is the most important thing. You're never going to get a trade perfect, but you can always do something a little bit better. And, over the course of 10, 20, 30 years, just small improvements with each trade, even with each year, are going to translate to much better execution, much better, a much better process, and ideally much better results over time. So that's basically the key thing. Whenever you look back at a trade, think about what you could have done better and what you can learn from that experience, whether it was a loss or a gain. Okay, so that's kind of the bulk of my presentation. I have no idea where I'm at time-wise. It looks like about 50 minutes. So I've just got a few kind of key slides that are things that are really important to me that I've learned over the past few years. First, when it comes to risk management, this is so important. Making big money does not matter if you can't keep it. I've seen so many people on Twitter who had fantastic, years in 2020 coming out of the COVID correction, made 300%, 400%, 500%, give it all back because they didn't have risk management and sell discipline. They didn't follow their sell rules, or they didn't have sell rules. They were buy and hold investors and didn't realize when, a stock entered stage 4 and the trend changed. So you have to manage risk and you have to manage your positions to make sure that you keep those profits that you do end up making. Also, one that's key, never average down, losers average losers. I'm sure there's going to be a time during the contest where you buy a stock, it stops you out, it goes down more, it starts moving up a little bit, you buy again, you get stopped out again, and it just keeps going down, 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 and you think, oh, it's cheaper. If it moves back to where it opened, it's going to be a great profit. If it breaks out, it's going to be amazing. But it can just keep going down, and the trend could have changed. So never average down. I think it was Paul Tudor Jones who said losers average losers. You always want to trade with the trend of the market, the group, and the stock. So you're always aligning those time frames and trading above moving averages. You always want to set a stop loss order right after you buy. As I mentioned, this is a mistake I've made in the past, and I'll never do it again. And you basically want to aim for 3 to 6% losses, basically as tight as you can without choking off the trade. And this amount is gonna vary a little bit depending on your style, depending on your position size as well, because the same loss, a 10% stop loss can be the same net dollar amount as a 3% stop loss, depending on your position size. So some people like to give stocks a little bit more room, but have smaller position sizes. Some people like to, really pound the table and go for it with large position sizes, and they keep those stop losses really small. So it kind of depends on your style and what you really enjoy doing. Number 4, manage your position size to keep your risk less than 1% of your portfolio. You can do the math to make sure that you never lose more than 1% on any given trade. And, better than 1% is better. You can shoot for 0.5%, 0.25%. Basically make sure that you're keeping your risk in check. So even if you have 10 losing trades in a row, you're not drawing your account down too much. That is a powerful thing when you do the math and realize that I could lose 15 times in a row and still have the majority of my capital. That means that you're managing risk really well, and that's going to prevent you from, terrible drawdowns of 25, 30, 40, 50, 60% that some people have experienced this year. And that's going to set yourself up beautifully during the next uptrend. So if you can learn to manage your risk and keep those drawdowns low, that's the best skill that you can develop as a trader or investor. Number 5 is kind of optional. You can scale into positions as it proves itself by going up. Once again, this kind of listening to market feedback and saying that the trade is working. I can add a little bit more. Some people do this, some people don't. I actually do not average up into positions. I add on the next setup maybe, but I don't add, on that day pretty much. I usually just do one buy and that's pretty much it. Number 6 is really key. Don't chase a breakout or a stock that's extended. This was a mistake I made during the contest is I would buy a stock that, you know, it had already broken out, and it was already, you know, 5%, 6%, 10% from the proper buy point. And then I would get stopped out during a normal, you know, short-term pullback, and then it would just resume higher without me. So entering extended is basically you succumbing to FOMO and just buying a stock because it's going up. Wait for a proper setup, stalk that stock, and wait for the next good setup to develop. Number 7 is kind of a little bit of what I've talked about here. You know, Dr. Wish mentioned the cheat entries. Try to find alternate entries before the true breakout, because a lot of people are watching that key level, and there can be a lot of volatility there. So look for downward trendline breaks, green dots, you know, pivots earlier, lower down in the base. Try to find a way in where you can manage risk tightly, and you're in close to that breakout level, but you've got a little bit more cushion when the stock does push through that spot. Number 8, I kind of talked about earlier. No audibles or buying just because somebody else bought it on Twitter. That's the worst mistake you can make. Always follow your own process, and that way you'll never have to listen to anybody, and you'll be able to manage your money. That's a powerful thing. And number 9 is follow your plan. Do your homework on the weekend. Do your weekend routine. Do your daily routine. That's what's going to set you up for success. Another key concept: one trade does not necessarily matter. Now there's like a caveat to this, because there's swing trading where you're just trying to turn over your edge. That's kind of what Mark Minervini does. Then there's position trading, which is more of what Jim Ropel does. I don't know if you guys know who that is, or have watched any of his interviews. I definitely recommend it. But his focus is trying to play that longer term trend. So be in a stock for months, while Minervini is just trying to be in a stock for a few days, a few weeks, and get that quick move, while Ropel is trying to get, you know, that 80%, 100%, 200% move. So it's kind of different styles a little bit. So for Ropel, one trade a year can basically make his whole year. But for Minervini, it's really about turning over that edge and flipping a coin, and you know, just using the math and getting your profits. While for somebody like Jim Ropel, it's more about, you know, managing one trade really well. So that's kind of a key differentiation here. But in general, no one trade will make or break your performance. The key is to apply sound rules for stock selection, entry, and position management. Over time, this forms your edge as you target high probability setups, let winners trend higher, and cut losers ruthlessly. You want to use stop losses to keep your losses small, and when you get a winner, let it work for you. You want to aim for a 3-to-1 or 2-to-1 average gain to loss ratio, and you guys will go ahead and calculate this later on in the course. And basically, if you use an average 4% stop losses and get an average gain of 12%, that's a 3-to-1 average gain to loss ratio. And with these statistics, what's really powerful is you can lose on 75% of trades and still break even. You just have to be right 1 out of every 4 times, and you're not experiencing a drawdown. You're completely fine. And if you're able to do, you know, if you're right 2 out of 4 times, you're going to do phenomenally well. And, you know, if you're right 50 out of 100 times, you're really going to move that needle and compound your account really nicely. So that's what's really key about having those positive expectancy 3-to-1 or 2-to-1 average gain to loss ratios. Now, if you've fallen asleep at this point, there's a time to pay attention. Here are some quick tips for the contest. One, as I mentioned before, focus on disruptive, life-changing stocks, which are in long-term uptrends. It's hard to find those right now. There's only a few groups that are acting well. Look for superior earnings growth, sales growth estimates, great price and volume action, stocks that are above the moving averages, right near all-time highs, as the market, you know, is right near lows for the year. You want to buy right and sit tight. Buy right after volatility is minimized. That's kind of what I talked about buying those short-term flags or volatility contractions. You want to buy as close to that entry point as possible. Don't chase breakouts. And basically, and I think this is the most important thing, is learn by trading. I highly encourage you, everybody in the class right now, to actually participate in the contest. I know that's been, you know, a problem with a few people in the past. You're not going to learn anything if you don't actually participate in trades. So even if you're hesitant, even if you're nervous, even if you feel like you're not going to learn anything, make trades, and I promise you will gain something beneficial from it. You want to experiment with setups. You want to find what works for you and makes sense to you. And the key thing here is manage risk. If you do this and you actually do a bunch of trades, you're going to learn an immense amount from it, and you're going to have the opportunity to learn and know more about stock trading than 99% of people in the US. So that's a really powerful statement, but you've got to trade to gain that knowledge. So I think that's pretty much it. Yep, right about an hour. So thank you so much for your time, and I'd be happy to answer any questions you guys have.
Raise your hand if you have a question. We'll bring you the mic. Richard, I think that was fantastic. And a lot of what you said would work beautifully with people who want to become traders and who are going to watch their monitor all throughout the day and go to the 60-minute charts and whatever. But I'd like you, if you would, put yourself back in the class 3 years ago. And you know the types of rules we have. You can only buy 10,000 of something. You have to buy at least 9 or 10 different symbols. You have to get invested within the first week, 90%. And keep in mind that these are students. I don't know what you did, but most of the students, they have a lot of other work and they're not going to be watching the market every minute. How would you modify what you presented? What would you urge them to do if you had those types of rules that you had to do? And I realize this is really difficult in a down market like this, in a weak market. But still, if you were faced with starting next Monday, putting at least 90,000 of a 100,000 margin account to work, what do you think you would do?
Yeah, that's a really good question, and you're absolutely right. I mean, this is the toughest market, in quite a while. So what I would do is zoom out a little bit, focus on the best performing groups and the best performing stocks in those groups. Right now, the oil and gas theme is kind of reinventing itself a little bit. Those have been acting well. That could change next week. But if you are going to go long those stocks, the strongest stocks with the greatest patterns that are above their moving averages. And if you want to remain invested, what you might want to do is, not manage risk so tight, but manage risk with the stop loss so tight, but manage risk with that position size. So you might want to go a lower position size, but maybe move that stop loss down to the low of the previous week, just so you get stopped out a little bit less. There's a little bit, less churn in your account. So that's one thing. Another thing would be to invest some and hedge some with the inverse ETFs. That's definitely an option here. The trend is kind of down pretty much on most time frames. So that's kind of what's working at this point. So you can kind of balance those longs with inverse ETFs, kind of balance out the dollar allocation. So you're kind of hedged. So you're good if the market continues to go downwards. You've also got some money invested in the best longs the market has available. So maybe those groups continue to perform well, even though the market pulls back, you make money. Or even if the market pulls back and those stocks don't do well, you do well with the inverse ETFs. So yeah, I would suggest if you're going to go long, focus on the best stocks in the best groups. Widen up those stocks a little bit, but manage risk through position sizing, and of course take advantage of those inverse ETFs.
Yeah, I would agree with that. It was beautiful. I think that the key thing is to come through this next 7 weeks or so when they're trading, losing the least amount of money, being invested, but losing the least. Yeah,
if you can do that in this market, you're going to do amazingly well when there's the next bull market, which is going to be a big one. So it's a great time to learn, even though it might feel super frustrating. You get stopped out all the time. But if you can manage your risk and do well in this contest, that basically should prove to you that you've got skill in this and you can manage your own accounts.
Great. Thank you.